Hello and welcome to the latest investment market update. I'm Brian Morman, Chairman of Grunston Financial, and today I'm being joined once again with Mark Shields, who is the Investment Director at Brooks Macdonald. Brooks Macdonald have been carefully selected to manage the Grunston investment funds, and utilising their expertise, the team analyse movements within the market and make tactical changes. In this video, Mark will be answering some topical questions and provide us with a wider context as to what has been happening in investment markets. Good morning, Mark.
Morning, Brian.
Thank you for joining us. Inflation and interest rates. We've seen a degree of volatility in the bond market at the start of 2024. What's been the main cause of this?
Yeah, we have a little bit. So what really happened was at the end of 2023, we saw bond markets and equity markets rally quite heavily off the back of some more sort of dovish comments from central banks, predominantly the US, but also reasonably solid economic data and also some weaker inflationary data or inflation coming down. So that drove a pretty strong rally in the last quarter or so of 2023. However, in 2024, what we have seen is a slight reversion. So we've seen inflation remaining elevated. It's come down and sort of plateaued. But also we've seen relatively strong economic data from the US in particular, which has meant that the market that had priced in the idea that we were going to see an aggressive series of rate cuts in the early part of 2023 has revisited that assumption, and in light of that data has started to think maybe we're more likely to see rates happening at some point in 2023, but not quite so soon. And that's led to a degree of volatility, particularly within the bond market. The equity market less so. The equity market has sort of almost ignored this a little bit and continued to power on, but it has led to bond market in particular moving around quite a bit.
Thoughts on interest rates going forward?
Yeah, I think our thoughts really are that probably the market assumption that we're going to start seeing aggressive cuts come March was probably a bit optimistic. However, we probably do expect there to be some rate cuts in 2024, but maybe not starting till a little bit later in the year. Maybe in sort of late spring, early summer, we might start to see some cuts. And I think the market has started to move in that general viewpoint now. Obviously, I think that viewpoint would be quite dependent upon the data that we see coming through from the inflationary data that we get, as well as the economic data. And also, for that matter, what's happening more kind of broadly in terms of geopolitical picture as well.
Indeed, picking up on that, the Middle East, how do you see this affecting markets?
Yeah, obviously we've seen a lot of sort of issues out in the Middle East, and it's been tragic in lots of ways, of course. Broadly speaking, at the moment, it doesn't seem to have had a particularly detrimental impact on global markets. We haven't really seen a particular spike in energy prices. But that could change, especially if we start to see the conflict beginning to broaden out. We have seen the US starting to bomb Iranian-linked militias or terrorist groups more actively. If we do start to see some sort of embargo or more kind of restrictive oil export policy coming through from places like Iran, then that could lead to energy increases. We're also seeing shipping costs increase as well, as the Houthis are continuing to attack shipping coming through the Red Sea, etc. So we might well start to see that feed through to those inflationary numbers going forward. But I also think that we're in quite a different world now to what we were in back in 1970s, when we last saw the oil crisis really have a massive impact. And actually, I think the likelihood that we're going to see a significant energy price spike is diminished now compared to back then. The US is generating a lot more oil than it used to. We're more reliant on renewables. So the world is quite a different place, but it's definitely a risk that we need to be aware of, and it could have further issues down the line that are difficult to predict.
Okay, stock markets have had a reasonable run of late. How do you see that continuing?
Yeah, they've had a very strong run, really sort of starting in kind of late October 2023, and they've continued through to now. As I said, we've seen more volatility in the bond market, but the equity market's largely been ignoring that and continuing to drive through. What we've really seen is that it's not the broad equity market it's performed okay, but actually the vast majority of returns have come from the Magnificent Seven, the tech and those mega cap names where have been delivering some decent earnings, but there's also quite a lot of valuation risk associated with them as well. They're sitting at very high multiples in terms of what people are willing to pay for them, but they have continued to drive forward. And that may continue, but I think we are quite conscious of the risks associated with that. And if we start to see any misses in terms of earnings or any sort of change in investor sentiment, those companies could be hit particularly hard, and that would potentially drag those big indices and stock markets down because they are so dominant in those spaces at the moment. In fact, we started to see a bit of a change in fortunes within the Magnificent Seven, with companies like Tesla coming off quite heavily. I think it's down around about 20% year to date, whereas companies like Meta have actually had a very good year in 2024 because its earnings were ahead of expectations. So, we are continuing to see this dominance within a very limited number of names, which does present some risks to continued further growth in the market. But if we see that broadening out, then that's quite a healthy thing to see. We haven't quite started to see that yet, though.
Okay. Reasonably positive.
Reasonably positive, yes. I think we think that there are some good sort of reasons to be positive for 2024 around the inflationary and interest rate picture. We do expect there to be some interest rate cuts later on in the year, which should be beneficial for both bond and equity markets.
Yeah.
US earnings season that we've seen so far has been broadly positive, but there are risks. We're conscious of the valuation and concentration risk we're seeing in markets at the moment within that Magnificent Seven. We're conscious of the geopolitical risks, predominantly the Middle East, but also the more specific political risks as well. Obviously, 2024 is going to be a year where we have a lot of elections. We've got probably the UK election at some point this year, but the big one obviously being the US. And if we do see a Trump administration coming into sort of power, as it were, in the US, that may present some risks as well. So I don't necessarily think it's going to be plain sailing, but I think that there are some reasons to be reasonably positive in 2024. But with that sort of slight eye on the fact that we don't necessarily at the moment want to be really swinging that risk bat, as it were.
Okay, well, thank you, Mark, for those insights, and thank you very much for watching. As always, if you have any questions or queries, please be in touch with us. Thank you.